Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. McIntyre Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement, Northwestern Ohio's resource for that common sense approach to planning that we all need, helping to uncomplicate the financial world. He is Chris Mcintire, president and founder of McIntyre Retirement Services. And Chris, we appreciate your time. Happy Labor Day weekend to you.
Yeah, happy Labor Day, Peter. It's hard to believe that kind of another summer's gone by already, and we anticipate it so much, and then it seems like it's gone in an instant.
Yeah, it's July 4th, and then all of a sudden it's Halloween and Christmas. It's crazy how the last half of the year goes. But Chris, on this weekend in particular, we celebrate the hard work of the American population with hopefully an extra day off of work. But ultimately, when we talk about how you plan and help people to retire, that's really the ultimate celebration of all of our years of work that we're putting into trying to get to a point where we no longer have to do what we have to do and show up to work to pay the bills, and we get to actually do more of what we want to do.
Yeah, Peter, I think it's a fair statement to say as people get older, closer to that 60-year mark, for most of us, and you want to slow down a little bit, start to enjoy life a little. You've probably focused a little bit more on health, and, hopefully you've created some wealth so that you can enjoy it while you have good health. And, a lot of uncertainty, obviously. It's an anxious time for a lot of people. If you've had some health issues, this time of year, people are catching up on scans and, oscopies of some sort, or, all those types of things, depending on your gender. And that can lead to some anxiety as well. We've dealt with that personally within our family as well, buddy.
Well, we've got to have a plan in order to be able to enjoy and have confidence through 20 to 30 or more years of time off that we refer to as retirement. And ladies and gentlemen, if you'd like to have that plan in place to build a little bit more confidence in your quality of life and know that your dollars are doing the right things to support that confidence, pick up the phone and give Chris Mcintire and McIntyre Retirement Services a call. 800-868-1194. That's 800-868-1194. 800-868-1194. And Chris, this weekend, I sort of have been thinking of and reflecting on the history of work in our country. And while we always seem to find some way to have something to complain about, all in all, we have it pretty good here. And it's the celebration that in this country where we are today, if we do work hard, we've got the ability to give ourselves a standard of living that is comfortable. We've got the ability to change our standard of living and our quality of life and move up socioeconomic classes with the modern environment that we are working in today.
Yeah, Peter, if you want to take a look back at it, we're coming up, it's 2021, and, over 100 years ago in 1913, they created the Department of Labor, to try to, if you want to think about Henry Ford, the automobile, the mass production there, and, kind of the treatment of certain employees, I can say that because we're very close to Detroit here. So that some of that hits home, but, what the United States has done to treat its workers fairer, to establish, I don't want to use the term living wage, but, because it's a politically sensitive term right now, but, to where we have standards that, you can aspire to achieve some greatness here, or not. And, just what a country and the land of opportunity here that is benefited, not only males, but females. We're seeing more and more women enter executive positions, people of minority as well. And, a great diversification, which is the melting pot that is America.
Yeah, we've built safer working conditions. We've tried to address discrimination for gender, age, for civil rights for workers. We have tried to help those with disabilities have a more fair shot in the workplace. A lot of improvements over really just the last 100 years, Chris, that have been significant improvements in the working and the living conditions for Americans. And I just think on this weekend we could reflect and appreciate how far we've come. Is it perfect? No. Could we still have some things that we could improve upon? Absolutely. But we have come so far and have made such improvements. So that's one way that I think that we could reflect and appreciate this holiday and the Labor Day weekend. But ultimately, Chris, we as individuals have to do a lot of work. We have to work very hard so that at some point we no longer have to work. And in order for that to happen, we do really need not only to work and earn money, but we need to save money and build some wealth and then have a plan for how that money can replace our paycheck and replace our labor. And that's the place where I think you provide the services for your clients there at Mcintire Retirement Services.
Yeah, Peter, it's where we've built a niche, obviously, in what we do for investors. We help people in that transition from pre-retirement to retirement and then through retirement. We're not always the firm that's going to help somebody who just got their first job out of college. That's not necessarily where our practice is focused. We uncover opportunities, whether that be taxation, estate planning, the long-term care planning. So yeah, we do encompass a kind of a specific target market there, if you will. And, here in the U.S., again, just to reflect back on, the land of opportunity, we've got the Family Medical Leave Act that, big corporations. I'm a small business, so, we get to fly under the radar of some of those. We don't have to carry some of the burden that's out there. And, as far as paid time off for someone having a baby, that type of thing. So, but we also suffer from the law of unintended consequences on that. And I think you and I have spoken earlier about the extended unemployment benefits and companies struggling to get people to come back to work, on the other side of the pandemic here. So, yeah, as well-intentioned as some of these, programs are, they certainly can also have the reverse effect that some people do actually exploit them to their own advantage, unfortunately. And, that's a fair statement to make as well.
Well, for most of us, Chris, what we do for money is work hard for it. We set our alarms, we put in the hours, we put in the sweat equity, we push ourselves, we get an education, we put in applications. At some points in time, we're even willing to relocate our families for better opportunities. Social status is linked to our jobs often. Our mental confidence and well-being, sense of accomplishment can be linked very closely to our job and our job performance. With all that said, money is not the most important thing. It's not even the end all goal. Money is the tool to support what is important to us. And again, Chris, I think that in the planning process is where the rubber meets the road in how to identify and utilize the correct tools in order for our money to provide us with the ability to achieve and accomplish what is important to us, and to provide for a reasonable standard of living that we can feel comfortable with.
One of the most rewarding things that we do, Peter, is when someone comes into our office and hey, they've saved, they've got 401ks, they've got Social Security, they may or may not have pensions. They just don't know what to do with any of it. So for us to come in and kind of start this education process, and sometimes that starts at some of our educational events that we host around the area here, and then lay out for them the specific options that they may have, saying, when do I start taking my Social Security benefit? What do I do with my 401k? I've got a Roth IRA. What makes sense? What do I use the Roth IRA, which is tax-free money, for? And it looks like I've inherited some money from my grandparents or my parents. What do I do with that? What are my tax liabilities? So when you can sit there and have conversations with folks and show them what things look like in real time, Factor in inflation, factor in the sudden loss of one of the two of them, of a married couple, for example. It's really rewarding to show them how to hedge those risks, and then, kind of watch their shoulders relax a little bit, that, hey, we're providing them some peace of mind, which helps their quality of life.
Well, Chris, when I think about money and the order of operations, typically pay taxes, pay bills, I spend it, and then I save it. And I have to realize that once I do those first three, that money is gone to me forever. Only number four, only what we save and what we invest is there to recreate our ability to pay taxes, pay bills, and spend or give or have fun or take trips and do all the rest of the things. Only what we save and invest is left for that. And you just named a lot that goes into the planning process, and a lot that we need to consider with what we save and invest, and how we are going to be able to recreate those first three. Being able to continue to pay taxes, those won't go away in retirement. Being able to continue to pay bills, budgeting, having a spending plan, and then to have fun and do the rest of what we envision our money to be able to afford for us.
Right, Peter. And you want your money to work for you versus you working for your money. And, an example of that would be, someone investing overly conservative, if you will, and not making enough of a return to keep up the pace with inflation, and making emotional decisions based off of headlines. Those are a couple that come to mind real quick there, where they're not letting their money work for them over the course of their lifetime. They're making, quick gut reactions, if you will. So we want our money to go to work, right? And so there's a number of things we can do with it. We can grow it, with or without risk, or a combination of some safe money as well, as we always talk about, and some growth money. It can be liquid. It can provide you income. And, and what are the best options to put your money to work for you? If you're, 56 to 60 years old and you got a 30-year time horizon yet, you got to be careful being overly cautious, right? Because you still got some of that money you're going to need 20 years from now. Maybe that's what you should have invested a little bit more aggressively. Some high quality dividend paying stocks, some growth vehicles, that type of thing. The money you need on the shorter term, right? Hey, maybe that's in short-term bonds. That's in a savings or a checking account. If you've got an expense that's coming up in 1 to 3 years, you want to buy that second home. Don't want to be too speculative with that. You've got money you want to provide you with an income. So you may have an income allocation asset there that can provide you with an income that can also increase with the rate of inflation, or some potential way to increase your income and to cover Social Security, your pensions, and your other income elements there, to build and cover your basic living expenses from now until your final days, if you will.
Well, Chris, during our working career, our money is sort of a part-time employee. It really only has one job. It's there to grow and accumulate and build as much as possible. But when we retire, it's got to replace all of the labor. It becomes our full-time employee. And you just listed a number of different things that we need our money to do. That's why there is an importance in diversification, and specifically as we enter into that transitionary period, the red zone it's been called, as we're moving from our working career to retirement. We really need to revisit the plan and potentially assign our dollars some new jobs and new tasks, and evaluate whether or not it's performing those tasks.
Absolutely, Peter. And, if you want to think of money as a, as a workforce, or as even like a baseball team, we're still here in the heart of the baseball season. Not all of your money is going to play the position of being the pitcher, right? Because you wouldn't win very many games. You might be exciting to watch, but you're going to need somebody at shortstop. That's a key player. You're going to need somebody in the outfield to be able to catch some of those fly balls and play some defense. So again, money can play offense and also play defense, and you have to utilize it for different, different elements throughout your retirement income. So that means you're going to have different vehicles instead of different team players, but different vehicles to play those different positions for you throughout your retirement is probably a good analogy.
Chris, this is ringing true for me. I coach my sons. It was recreational league, rec league, and then travel team. And the first day with the new team, I always tell the kids, okay, run out on the field and take the position that you like to play the most. And almost inevitably, I'd have 2 or 3 kids at pitcher, 2 or 3 kids at second base, and then the rest of the team at first base. And I'd talk to them. I'd say, hey guys, this is fantastic that I've got so many good athletes willing to play these positions, but look at the rest of this field. We're not going to win if everybody only plays these positions. And so we've got to mix it up, and I've got to put some kids in the outfield. I got to have a catcher. What you just said, I mean, for me personally, with that experience, you've got to have, with your money, to complete the analogy, different dollars playing different positions, doing different tasks for us. And you mentioned income allocation. This is actually a specifically different approach and a different type of diversification than the traditional approach that we are taking for that growth and accumulation, both being an important job. But as we're making the transition, income allocation, more specifically, time optimizes our dollars. So we know when we're going to use them, and therefore helps us arrive at a conclusion of what tool to use to be most effective for when we need those dollars.
Yeah, you're absolutely right, Peter. Think of it this way, if there was a stock or a mutual fund, that doubled your money last year, like, for example, some technology pieces that did incredibly well during the pandemic, they could also, get clobbered as we recover and people go back to the office and rely less on technology. So that stock or that mutual fund may not be a very good income producing vehicle because of the volatility that it has. So there are instruments and investments that make much better income generating vehicles than they do growth vehicles. So having a combination of the two obviously would make sense, and in many, many cases is truly in the client's best interest, the win-win, and who doesn't want that?
If you would like to take a look at your portfolio, make sure that you are properly diversified, understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how to assign your dollars specific tasks, how to translate the lump sum that is geared toward accumulation into an income producing tool to replace the paycheck and replace yourself as the primary employee, pick up the phone and give Chris Mcintire a call, 800-868-1194. Again, we're talking with Chris Mcintire, Northwestern Ohio, your resource for that common sense approach to planning and to help you formulate the plan, or even if you already have a plan, to spot check the plan, to make sure the plan is complete and addressing all of the things that you will need moving into and throughout the future. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194. 800-868-1194. And Chris, I know that the income allocation and time optimizing the portfolio, because we are walking away from the paycheck and have different needs, it kind of has a different process at arriving at a conclusion for how much is needed, and to understand kind of the question of how much do I need to retire, or when can I retire?
Correct, Peter. And it's often one of the most common questions we get. I'm going to retire as soon as you tell me I can retire. Then my typical, rebuttal to that is, how much do you need a month to live off of to cover your basic living expenses? And many times they have that calculated. So let's say they need $5,000 a month early in their retirement because they want to do some traveling, don't have any real expenses. If the house is paid off, $60,000 a year can certainly go a long way if you don't have kids at home. And so let's say $2,500 a month of that $5,000 comes from Social Security benefits. Now we've got to generate $2,500 a month, or $30,000 a year, basically, off of an investment portfolio. If that investment portfolio had $1 million in it, we need 60,000 or 30,000 out of that, because 30,000 is coming from Social Security. That's a 3% withdrawal rate. That's not a bad, that's a very achievable goal, if you will, by looking at some income generating pieces, some growth pieces as well. But if you needed $50,000 or $60,000 a year out of that $1 million, that's a pretty big withdrawal to start taking off of $1 million, 6%, if you will. 4% was the old rule of thumb adjusted for inflation. So you don't want to start off with 6% and then start adjusting for inflation. Those might be some unobtainable goals, if you will. So look at what is the best method to cover those basic living expenses for you. And does it make sense to carve a piece of that $1 million off into an income generation type vehicle for as long as you're alive, as long as your spouse is alive, with the potential to increase that income to help combat inflation, and let investments be investments, let income be income, if you will.
Again, we are talking with Chris Mcintire, president and founder of Mcintire Retirement Services. And on this Labor Day weekend holiday, as we are celebrating the hard work of the American public, to celebrate your hard work, the ultimate celebration is retirement, but you have to have a plan in place in order to retire with confidence, use your dollars efficiently and effectively. That's what Chris Mcintire will help you do. Formulate that plan. Pick up the phone, give a call, 800-868-1194. That's 800-868-1194. Chris, you sent along a few interesting charts here that made me rethink some of the things that we have been told about money in the market and taking more risk in order to get more return, and what we should expect for the rate of return that we should be receiving. And we've had a fantastic last decade in the market. The last 10 years has been really a historic bull market run. But the 10 years before that, it had some volatility. It was a little bit of a roller coaster ride. And I'm sure that folks that would be tuned into a program such as this, we remember what the years from 2000 through 2002 and then the Great Recession from 2007 through 2008 felt like. But we also need to remember that during that decade, we had two different periods where the market gained 100%. The market gained 100% twice in the 10 years between 2000 and about 2013, a little bit more than 10 years. And yet, from 2000 through 2013, despite those two different periods where the market gained 100%, Chris, we were just about break even. The market did not always go up, nor even go up at all over that 13-year stretch. And so when we're planning for retirement income, do we need to plan as though we're going to have a best case scenario like what the last 10 years has been? Or do we need to plan for more conservative or even pessimistic, kind of a Murphy's Law type of scenario, and formulate our plans based around that?
Well, Peter, I like to always plan for the worst, because if it works under a worst case scenario, running illustrations and whatnot, then it'll work better under a different set of circumstances. And, sometimes that's eye-opening for people, and give you an example, the technology sector, the NASDAQ took 15 years, to get back to its all-time high from basically 1999 to, call it 2015, basically. I mean, it was a long time for it to break that 5,000 threshold again, and then it busted right through that. And as people right now are looking at, all right, I'm going to set my expectations based on the last 10 years. That's a very dangerous precedent, especially with all the pandemic spending that they've done. Are we just robbing ourselves of future returns by trying to fuel this economy to get everything back on the other side of Corona, assuming we're going to get back on the other side of Corona? I mean, it is certainly woken us up to realize it's not going away anytime soon. And, go ahead, Peter.
Well, I heard a couple interesting takes on this, and I heard a pundit on TV, one of the talking heads, saying, with all of the money that they've printed and dumped into the economy, 20% of the dollars currently in circulation have been created in the last 12 to 18 months. And he said, with all of this new money that they are creating and putting in the economy, the growth that we should have seen over the next decade has sort of been compacted into about a year's time period. The growth that the economy and the market should have experienced over a 10-year stretch, and the inflation that we are maybe on just the verge of seeing, all of that should have occurred naturally over the course of a decade or more has been compacted into a very short time period. Chris, what's your take on that?
Yeah, they have truly incentivized, the see it, buy it, gotta have it mentality by handing stimulus money out, by flooding the market with dollars, and these ultra low interest rate environments, people snatching up houses as fast as they possibly can. And, look at Florida, for example, a huge second home environment. Their prices of their homes has gone up. The supply is dwindled down to basically a 30-day supply of houses in the Florida market. And what's going to happen over the next 5 to 7 years once that market has been saturated? Is it going to, how do you sustain that type of growth? And if you think about, the housing market, look at everything that goes with the housing market. People buy washers and dryers and appliances, and they remodel. I mean, just a huge part of durable goods in our economic output. Or and what happens when that starts to slow down? How do you regenerate that when it's been force fed for how many years now?
Well, if you've got questions or concerns, again, Chris Mcintire, your resource, ladies and gentlemen, can give you kind of perspective on what you need to be thinking about, and can help you look back and plan for a more conservative estimate and projection of what may be to come in the future. Plan for the worst, hope for the best. That's the mentality during the planning process, so that if those things happen, if those things occur in real life, you are prepared for them. And that's the confidence that a plan builds. And then we can hope that the next 10 years looks like the last 10 years has looked in the market, but we're not reliant on that. Unfortunately, all too many people's plans are simply projections of a hypothetical rate of return for the future. You don't want to be reliant on that, because your outcome is only as good as the assumptions your plan is based on. Pick up the phone, give Chris Mcintire a call, 800-868-1194. That's 800-868-1194. And Chris, the charts that you sent along, I was really astounded, because it showed, despite the historic run we've had in the market the last 10 years, if we look back over the last 21 years to the year 2000, the average rate of return of the market over that 21-year period has only been 4.58%. And he sent along another chart that showed every 15-year period, going back from 1996 to 2010, all the way to 2006 to 2020, and every 15-year period in between, the average rate for all 11 15-year periods in that time, 4.73%. Now, many people's plans are based on some assumed rate that is significantly higher, 8, 9, 10% rate of returns. If we don't achieve that, we're going to be in trouble if our plan is based on that.
I couldn't agree more. Many pension funds base their returns off of numbers that they have been unable to hit. And that's why pensions are drastically underfunded by and large across the United States. When I build a retirement plan for somebody in our software, we use 5% before retirement and after retirement, because again, we want to plan for the worst, and you hope for something better than the worst case scenario happen. But if your plan works under what we would consider to be some of the worst conditions, it's going to work even better if any other result happens from that standpoint on the way up. And some folks, you look at them and you say, look, now's not the time to retire. Why don't you give it 2 more years? 24 months is going to go by pretty quick. It'll allow you to pay these assets down. You'll be able to get a little better cushion, and I guarantee you're going to feel a lot better about it. And, so when you tell somebody what they have to hear, not what they want to hear, then you've done your job, because anybody can tell people what they want to hear, because that's what everybody feeds off of, that emotion. But the brutal honesty sometimes is a hard thing to deliver to people. But you have to, if you're a fiduciary and you're acting in their best interest, sometimes you deliver great news. Sometimes you deliver, a result that wasn't what they had intended.
A little dose of reality in there is always going to be important. And I think, Chris, you're absolutely right. Too many people have financial projections that are based on what we would like to see happen. And that's fantastic. Those are the things that we would like to see happen, but we need to have a plan that's based on what could potentially happen, and then be prepared for that outcome. And then we can live with more confidence, because if those things occur, we have planned and prepared for them. Again, we are talking today on this Labor Day weekend, celebrating your hard work, the ultimate celebration being a confident retirement. And you've got to have a plan in place in order to have that confidence moving to and through retirement, replacing your paycheck, replacing yourself as the main earner of that paycheck. Your dollars have to go to work for you, and those should be structured within a plan that addresses the fees that you're paying, the risks that you're taking, the taxes that you may be liable for, how to generate that income, and so many other of retirement's biggest risks. Those are addressed through the game plan for retirement that Chris Mcintire will put together with you, for you, show you how to avoid large losses, minimize fees, significantly reduce volatility, earn a reasonable rate of return, manage taxation, generate an income that will last for as long as you are alive. In fact, getting that written retirement income plan in place, that's the huge benefit of having that game plan for retirement strategy session with Chris Mcintire. Pick up the phone, give a call, 800-868-1194, 800-868-1194, 800-868-1194. You can also visit online, McIntyreRetirementServices.com, McIntyreRetirementServices.com, or once again, 800-868-1194. Chris, we always appreciate your time here on the program. Hope that you are enjoying your Labor Day weekend, a little time off for you as well. And thank you for being here as the resource for so many savers and investors, retirement-minded individuals across Northwestern Ohio.
My pleasure. Hope everybody has a safe weekend out there and enjoy that extra day. Fall's coming and the snow will fly after that. So enjoy it, folks.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.